Multi-asset funds are one-stop diversified portfolios, and they now make up £145 billion of UK investor money. But the quality varies massively, and some cost as little as 0.2%, whereas others cost 10 times as much. In this video, I'll explain how to choose the right multi-asset fund for your risk level, your goals, and also your platform, and I'll show you some surprising data about fees and returns. And I'll end with the funds which I consider to be the best. Today's video is sponsored by Freetrade, the commission-free investment platform. So what are multi-asset funds? Well, multi-asset funds hold more than one asset class. Usually they consist of equities, bonds, property, cash, sometimes even commodities and infrastructure or alternative asset classes. Now, they are classified by the Investment Association into sectors, and these are handy, I think, because they give you a really good idea of how much equity risk each fund is allowed to take. For example, cautious funds can hold up to 35% in equities and must also keep a big chunk in investment-grade bonds and cash. Balanced funds step that up to between 20% and 60% equities, and these mix growth potential with bond stability. Growth funds push the risk further, and now we're talking about between 40% to 85% equities, and these are for investors who want more upside but are also comfortable with more volatility. Flexible fund managers can hold anything from 0% to 100% equities. And finally, volatility managed funds vary the allocation in order to keep the price fluctuations within a range. Now, these definitions make it easier to compare funds on a like-for-like basis, and also to understand the level of risk which you're really taking. So these funds are designed to give you instant diversification and smoother returns than you'd get if you had pure equity funds. Why do people choose these funds? Well, I think there are three main reasons. The most important one is probably simplicity. Now, here you're going to get diversification built into the fund, and all of the rebalancing is done for you. Secondly, it's about risk management, and these funds often aim to smooth returns and also to cut big drawdowns, particularly if you go for those lower risk categories. And also you get professional oversight. You don't have to worry about daily markets, you just buy the fund and hold it. But of course, these funds do have downsides. For example, if there is a huge rally, well, you won't participate in that fully if you've got a lower risk version of one of these funds. Sometimes you get a stacking of fees because these are funds of funds, and that sometimes does eat away at your return, as we'll see. If they are actively managed, these funds are also going to rely heavily on the skill of the active manager, because now the manager's got more leeway to choose different asset classes. And then finally, one of the drawbacks is that if you're in retirement, you don't have control of which of the assets you sell in order to generate an income. If you split your funds between risky funds and safe funds, then you have that choice. And if there is a crash in risky funds, you can choose to live off the safe things which haven't crashed. But certainly in accumulation, I think this is a fairly good choice for someone who's just starting out and really wants to keep things simple. Now let's look at fees. Now, I consider a reasonable fee to be around 0.3% or less for a multi-asset fund. And it is disappointing to see that the median or typical annual ongoing charge is still around 0.8%. You can see that there's a long tail of funds which charge 1% or more, with some charging almost 2% per year. Now, there aren't many funds below 0.3%, which is where Vanguard LifeStrategy, HSBC Global Strategy, and Schroeder multi-asset portfolios live. Now, the reason why fee awareness is such an important factor when choosing these funds is that over many decades, the compounding drag of fees is enormous, and the most expensive funds simply don't outperform. So here I've compared all the cheapest multi-asset funds with fees below and including 0.25%. What really stands out is how competition with Vanguard LifeStrategy has squeezed fees for many of the largest fund managers to be at that level or lower than LifeStrategy. There are several choices now from providers like Schroeder, HSBC, and Fidelity. This gives you a quick at-a-glance map of who offers low-cost options. So how much do the returns of these funds vary? Well, I think to make things fair, it's good to look at a long period of time. So we'll look at the last decade. And as you can see, there's a massive dispersion in returns. The size of the circles on this graph shows the size of the fund itself in terms of assets under management. And I've highlighted 3 of the multi-asset families. So that's Vanguard's LifeStrategy funds, HSBC's Global Strategy funds, and Fidelity's multi-asset allocator funds. Now, funds with a similar risk level, in other words, the same X value on the graph. So look at a vertical slice on that graph and you'll have funds with a similar volatility. But within that slice, you often see wildly different returns. So for example, if we take a vertical risk slice around LifeStrategy 60, you can see that many of the funds with comparable risk underperformed Vanguard's fund and about 2 or 3 funds beat it. Now, a handful of these funds have done very well over the last decade, but what is disappointing to see is that many of them cluster in low return territory given the level of risk they're taking. So I think what this shows is that just buying a multi-asset fund isn't good enough. You have to pick amongst them carefully. You might think I'll just pay a bit more in fees to get better returns. However, this scatter plot shows you that the story isn't that simple. Higher fee funds tend to deliver lower risk-adjusted returns, particularly for very high relative fees. Again, notice the Vanguard LifeStrategy funds on the left-hand side of the graph here with low fees and respectable returns. Now in this graph they look like a vertical line because they all have the same fee. The surprising truth is that you don't pay more for better outcomes, you pay more for worse outcomes. That's why the rest of this video focuses heavily on cost. Before we go on to talk about a checklist for how to choose multi-asset funds, but also my choices of which funds I think are best, today's video is brought to you by Freetrade, the commission-free investment platform. Freetrade has a limited time cashback offer on, and right now you can get 2% cashback when you transfer £10,000 or more in pensions to Freetrade. Cashback is capped at £1,000 per customer and the offer ends on 31st of December 2025. There's also an ISA deal for new ISA customers. Freetrade's ISA is free and you can get 1% cashback when you transfer £10,000 or more with a cashback capped at £1,000. This offer also ends on 31st of December 2025. Plus, if you know someone already on Freetrade, ask for their referral link and you'll get a free share worth between £10 and £100. And now, Freetrade has added hundreds of professionally managed funds so you can easily diversify your portfolio, all within the same simple platform. What I like about Freetrade is the simplicity. You can invest in a few simple clicks using their web platform or their mobile app. Freetrade's big selling point is that they're among the cheapest ways to invest in a SIPP or an ISA in the UK, with simple and transparent pricing and a free ISA. Freetrade won Best Online Trading Platform at the British Bank Awards 6 years in a row, and over 700,000 customers trust them. To get started, head over to freetrade.io/pensioncraft or check the link in the description below. So how can we choose multi-asset funds? Well, personally, I think that this checklist is helpful. So starting with risk level, I think the investment association sectors make this much easier. If you're cautious, maybe the 0 to 35% band would be interesting. If you want a more balanced approach to risk, 20 to 60%, and if you want growth, 40 to 85%. And if you want maximum flexibility, then the IA flexible sector might be one to choose. And your time horizon is also a key driver. The longer you have to invest, the more equity you can afford. Also, the more comfortable you are with loss, the more equity you can live with. In terms of asset allocation, there are certain things to check. For example, how much is invested in the UK versus the global equity weight of the UK. A lot of these funds have a UK bias. Remember, the UK makes up 4% of global equity. how much of the investment is truly in bonds and which bonds are those invested in. Do they use property, commodities, or alternative investments? And do they hold other funds, i.e., is this a fund of funds and is that reflected in a high fee? And another key consideration is how diversified the fund is. If you've got genuinely uncorrelated assets, that's going to dampen volatility more than if you just got different flavors of equity, which wouldn't diversify as much. When it comes to fees, you'll find that passive funds are often much cheaper, and in most cases they perform very competitively. For example, Vanguard LifeStrategy funds have a fee of 0.22% and they've got a very fixed allocation, whereas other funds use an active approach which may or may not increase returns in the future. So I think active options might be suitable for you, but there are certain things to check. So look at the historic return and divide it by the volatility of the fund. See how large the falls have been historically, i.e. how deep and how long those falls have been from the previous all-time high. How long does the average manager stay in the fund if it's actively managed? How stable is the investment process? Is that being changed all the time or has it been very constant for a long period? And also how well has the fund performed across different economic cycles? Now it's a good idea to compare historical returns, but you have to do it fairly. For example, look at the volatility of the fund and then compare return with other funds with similar volatilities. Another thing to check is that you're comparing accumulation with accumulation and income with income funds. Also, make sure that the currency is the same, otherwise returns in US dollars and sterling will be different, and you won't be comparing like with like. Style and geographic biases are also often missed. For example, LifeStrategy's got the UK equity tilt. Some funds may have a lot of tech inside them and also a big US tilt. And some funds might have a lot of emerging markets. Even in fixed income or bonds, you could have a big tilt towards the more risky part of that asset class, like junk bonds, for example. And if you do go for actively managed funds, well, there the manager's absolutely critical. Now, I tend to avoid active funds, but if you like them, then find out who the people managing the fund are and see if they've been interviewed and do you agree with their approach. If you can find their track record, so much the better, but often that's quite tricky. Plus, the managers themselves tend to move around between funds. And finally, the funds that we've looked at have been open-ended investment companies or OICs. Now, some investment platforms are ETF only, so make sure you can buy the funds you want on the platform you use. I think it's best to do your own research, but in case it helps, here's my short list of the best multi-asset funds. I think for people starting out in investing, the low fee and long history of the LifeStrategy funds is difficult to beat. Vanguard LifeStrategy employs a committee-managed passive approach with fixed equity to bond ratios. The funds maintain rigid allocations of 20%, 40%, 60, 80 or 100% equities with the remainder in bonds. And there are 3 tiers of committees which determine the strategic positioning, that's how much the long-term weights are, and that changes fairly infrequently, and the funds rebalance on a daily basis, and this ensures that the allocations remain completely on track. If you buy LifeStrategy 60, it'll always be close to the 60% in stocks and 40% in bonds, which it says on the tin. Vanguard LifeStrategy maintains a significant UK overweight with 25% of the equity exposure and 35% of the bond exposure in UK assets. So for example, for LifeStrategy 60, this creates approximately 15% in UK equities and 14% in UK bonds. Now that's a substantial home bias, and this has undoubtedly caused the fund to underperform over the last decade. Now personally, I would not be comfortable with that size of home bias, but some people do like it. In fact, some members of our community have said that they've gone for LifeStrategy for particularly that reason. They think that the UK is going to outperform other countries. But with a 0.22% management fee, I think despite the UK overweight, LifeStrategy funds have long been and remain the gold standard for multi-asset funds. HSBC's global strategy portfolios come under the IA's volatility managed sector, but the principle's similar to LifeStrategy, with risk-graded funds based on exposure to more volatile investments such as equity. The fees are comparable to LifeStrategy, and what I like about them is the lack of any kind of UK bias. HSBC Global Strategy takes a pure global market cap approach. Typically, they'll have just 1 to 2% in UK equities and 1% in UK bonds, and that reflects the UK's actual weight in global indices. The balanced portfolio, for example, currently holds only about 1% in UK equities and 1% in UK gilts. Another difference is that Vanguard LifeStrategy hedges all of its bond holdings into sterling. Now, this does eliminate currency risk on the fixed income portion, but it also eliminates potential currency gains when sterling weakens versus the dollar, say. In contrast, HSBC Global Strategy doesn't hedge all of its fixed income assets. So this means that HSBC funds benefited significantly during periods of sterling weakness, particularly after the 2016 Brexit referendum, when unhedged global bonds outperformed hedged alternatives. Another difference with Vanguard LifeStrategy is that the allocation there is largely static, with changes only occurring occasionally. And as we said, the funds rebalance daily. In contrast, these HSBC funds make active tactical tilts against those long-term strategic allocations based on short to medium-term market views. And these tactical positions are monitored weekly and adjusted as market conditions change. So these might help or hinder return. It's impossible to know. The fund managers have got to be right after all, but I'd be a bit wary of this active approach. Fidelity's multi-asset allocator range of funds are a bit cheaper than Vanguard's at 0.2%, and they have been around for over a decade. It is a bit disappointing that they have underperformed LifeStrategy over that period of time, at least on a risk-adjusted basis, and that's despite their much smaller UK bias. Now, the difference may be due to Fidelity's explicit small cap allocation of approximately 6 to 8% across its range, and it implements that using dedicated small cap index funds. Fidelity also allocates 6 to 8% explicitly to global real estate investment trusts. Now, Vanguard does hold some REITs in LifeStrategy, but only at their market cap weight within equity indices, and that typically results in smaller exposure of around 2 to 4%. Another difference is that on the bond side, Vanguard LifeStrategy uses a significant allocation to UK gilts, those are UK government bonds. And again, that reflects its home bias, such that about 35% of the bond portion of its allocation is in UK government bonds. Whereas Fidelity employs a more global fixed income approach, typically it'll have around 20% in global government bonds and over 10% in global corporate bonds, and that's all in the lower risk portion of the portfolio. And it's got fairly minimal UK specific bond exposure. Schroders global multi-asset portfolios are actively managed using a 3-layer investment process. So they've got strategic asset allocation, like LifeStrategy. Those are their long-term weights, but overlaid on top of that, they've got the dynamic asset allocation and active stock selection. So rather than having fixed equity percentages, each of the funds targets specific volatility levels over rolling 5-year periods. So we've got cautious, that's 3% volatility, moderately cautious, which is 5%, balanced is 8%, growth is 11%, and adventurous is 14%. So the Schroders approach allows the portfolio management team to make tactical, that's short-term adjustments within certain risk parameters. And that way, at least in theory, they can exploit market opportunities and avoid risks. Recent examples of that might include using short index futures to hedge US and European equity exposure, and they did some tactical positioning in short-dated treasuries, and they added protection via credit default swaps on their high-yield exposure. And as we saw with HSBC, the Schroders global multi-asset portfolios take a more globally diversified approach than Vanguard LifeStrategy. They've only got a modest 10 to 12% overweight in UK equities and only around 2 to 3% in bonds. The balanced portfolio, for example, holds around 10% in UK equity via the Schroder Prime UK Equity Fund and around 3% in UK bonds. So that's a deliberate decision by the asset managers. They're trying to avoid this rigid home bias that LifeStrategy has because presumably Schroders believes that that's constrained some of their returns in the past. The Schroder funds have fees capped at 0.22%, and they describe this as active management at passive prices. So I think this represents good value for active multi-asset management if you want it, although Vanguard's significantly larger scale, they're about 100 times bigger as I make this video, demonstrates that Vanguard is really dominant in this market. So although the Schroder funds haven't been around as long as offerings from Vanguard or Fidelity, I think they're definitely worth looking at, although personally I might want to see a bit more performance history before making a judgment. So hopefully if you're in the market for a multi-asset fund, that's given you some ideas to start your own research. And if you do use multi-asset funds, let me know about your experience in the comments below. Do you prefer the flexibility of having more funds, or is one fund enough? Now don't forget the offer from Freetrade, the sponsor of today's video. You can get 2% cash back when you transfer £10,000 or more in pensions to Freetrade. The cashback is capped at £1,000 per customer, and the offer ends on 31st of December 2025. And there's also an ISA deal for new ISA customers. Freetrade's ISA is free, and you can get 1% cash back when you transfer £10,000 or more with the cashback capped at £1,000. And this offer also ends on 31st of December 2025. And, as always, thank you for listening.